everybody. Welcome to Friday, another Talk Money with Tom show. Our objective, of course, is to try to help you have a better retirement. It's our specialty. It's what we work on all the time. We feel like there isn't enough of a resource out there, so we created this channel, and you can obviously participate in this show. This is a live show. You can send in your questions at any time. We have two ways to do that. One is the email address, asktom@talkmoneywithtom.com, or put the question into the chat box. You can send in the email anytime during the week if you don't want to do it today. And then, of course, we bring up things that came up in our client strategy sessions that we think are important also. So hopefully you get something good out of today's session that can help you. We do like to continue the educational process with our clients and with our audience here. And so we're constantly putting out new content. You can subscribe to our channel. Hit the subscribe button and the little bell next to it if you want to get notified. And of course, you can meet with Ethan and I if you have some personal questions, something you'd like to ask. Go to our website. The link is on the site on this page here, and then go to the book appointment button up in the corner. So we can spend a half an hour with you, talking about your particular situation on the phone or video. So. Been doing this show for quite a while. Really enjoy it. Love the questions. Send them in now. See if you can stump us. Again, this is a live show. Love to try to answer these things live. Although it is kind of nice sometimes to get a little advance notice. We can make some charts and what have you. But nonetheless, go for it. See if you want to participate as far as that goes. So, of course, do always start off the show with a summary of what was happening in the market. We kind of divide this, concept of retirement into three pieces. From the financial side, there's lots of other pieces of retirement with health and, family and all these things, travel. But from financially, it's really asset management, right? And how to do the retirement planning and the tax planning. So this is about the asset management. We're trying to kind of educate what's happening with the market and what we see and how we're responding. Right now, we have 75% of our normal exposure to the stock market. So if you're 100% stock, then we're 75% in. If you're 60% stock, I think that works out to something around 48% or whatever that is. But and so we're still holding back some, but there have been some significant things that have happened here, even just this week. And so if you look at that red line, this is the S&P 500 from the all-time high, which was the 4th of January last year. And you can see we have pretty consistent touches across that red line on the high side, each time failing to get through, falling back down to some new lower low up until recently. And so there's kind of a checklist. What we want to see is a primary trend that is up. We all like that. It's a lot more fun, in my opinion. And right now the primary trend is down. And so there's some things that we look for to see that move. And so I'm gonna look a little closer. Here's a 5-minute chart of this week. And so you can see the red line is right there. We kind of jumped through at the beginning of the week. And then actually on the open after Microsoft's earnings reports, we opened below, but still got above it before the close. We've actually had, if today holds up, which it looks like it might, we've had 5 days in a row we've closed above that trend line. That's really important. So the checklist is fairly straightforward. 200-day moving average. And we've got above that several times. It failed, but we're above it again. Mm-hmm. Break that trend line. There we go. So far we broke that trend line. And then if I go back here, a couple pieces that come from Dow theory. So Dow theory, again, the Dow isn't just an index. It was actually a gentleman by the name of Charles Dow. And he started the Wall Street Journal and did all kinds of different research. But one of the things they talk about is primary trend and the way that a primary trend will go from, in this case, down to up, which is what we want to see. And the criteria that they use inside of Dow theory is that you want to start to see a low that isn't lower, but higher. So, for example, if you look earlier in this chart, all those lows are pretty much lower, 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 but this last low was higher than the October low that we hit. So good. That's another check mark. Then the next thing you want to see is higher highs. Obviously, haven't seen that all the way down that red line. All the highs have been lower. So right now, if you look closely at this, the high is around 4,100 for this last little run up that ran right up to the red line. We're at 4,093 right now as we speak. Almost there. Now, we bounced off of that twice. There's definitely some resistance there, so don't be surprised to see some pushback at that level, some selling and what have you. But if we can break above that, close above that for a few days, again, you got another check mark there. The only question I have is that's sort of a strange high, the way that it worked out. The one that's very definitive is the one that came in the summer. That's the high before this, which is 4,300. And certainly if we get above 4,300, then on a pure technical basis, the primary trend has changed. It's gone to up. And I'm not saying this is going to happen. This could fall apart from here. I'm just saying that right now things have been technically moving in the right direction. No ifs, ands, or buts. And this is a fairly powerful move if you really look at it from a granular standpoint. It looks very, very good. There's a lot of positive green all over the charts. We did have this before, back last summer, so who knows? But this is exactly the opposite of what was being expected in the first quarter. Expectation was that earnings would be bad, forward guidance would be bad, stock market would drop and come down quite a bit. Everybody's kind of in different ranges, but 10 to 50% is kind of the range for a majority of the articles that I'm seeing out there. This is what was supposed to happen the first quarter, second quarter of this year. Still might happen, but we're going exactly the opposite direction so far.
Yeah, a contrarian take would be quite profitable.
Yeah, exactly right. And sometimes, again, everybody gets on one side of the table and it goes the other way because it doesn't take that much to push it the other way. When all the institutions are out and they've lowered their stock market exposure and they sold as much as they're going to sell, and the individual investors come in, which I think is what's running right now. Because if you look at what's running right now, it's the same things the individual investors were pushing in 2020 that's doing well right now. And so they have enough power, even though they're not as big as the institutions, if the institutions sit on the sidelines. So these are good things. We just got today, let me switch this so we can see this a little better. We just got the PCE index, expended PCE index report. It's the personal consumption expenditure. And what this is the preferred measure of inflation by the Federal Reserve. The only disadvantage of this is it reports really late. I mean, Here we are late. It's 27th of, it reported today, the 27th of January, and, it's reporting for December. But this is what the Federal Reserve is looking at. This is what they call the top line, including energy and all those different type of food and such. So it's down to 5%, which was better than expected. Excellent. We're getting trends going the right direction. That looks really good. If we look at core, okay, now this is key because the core PCE, when the Federal Reserve talks about getting inflation back down to 2%, they're talking about core PCE, not 7% or whatever it is right now on the CPI, 6.7 or something like that, getting that down to 2. I keep seeing articles about that. That's actually not what the Federal Reserve has said. They're trying to get this back down. So we're at 4.4, closer, right? But that needs to continue to come down. Lots of things to go on this and see where this ends up and what have you. But the trend recently is certainly good. Today's report was good, better than expected. So excellent. And then a couple more measures of inflation that we always watch. This is the Fed funds futures market, a projection where the Fed funds might peak, in this case by July of next year. You can see that's actually come down some. It was expected to get to 5.1, and now it's down to 4.9, which is almost exactly what is expected by the market in terms of 2 more quarter point increases. One next week. Federal Reserve meets next week and Wednesday on the 1st. And then one in March.
Yeah, you were telling me that the market's predicting like 99% of chance.
99.1% chance of a quarter point increase. And so, and there's been quite a few interviews where they've talked about it being okay with a quarter point increase. They're trying to set the table some there. Now, the market is running, and the Federal Reserve doesn't like that right now because it lightens up money supply. I'm sorry, it releases money supply. People feel like they can spend. That's an inflationary event. They're trying to get people to do just the opposite of that. So we'll see what they have to say next Wednesday. So sometimes they use their rhetoric Yeah, one of the nice things this week is that they're in their blackout period and they can't run around and bring the market down with all their commentary. And lo and behold, the market keeps going up. So I like these blackout periods, but nonetheless, that's what's happening right now. Another measure of kind of the inflationary issue is the 2-year Treasury yield, right, which is also doing well, kind of peaked out, more or less on a downward trend, or at least sideways. So the inflationary pressure is relatively low. CPI numbers, core, non-core, top line, whatever you want to call it, PCE number, everything is showing that inflation is starting to get better. So that's good. And so that's kind of I think one of the catalysts that's definitely helping the market. Tech stocks respond very heavily to this 2-year yield.
Yeah.
When you see it come down, you'll see tech stocks doing better. And the Nasdaq's definitely outperforming the S&P 500 recently.
Yeah, you can see the tech, like SOX has been running real heavy this week.
Yeah, semiconductors are doing really well as an index, even though some of the companies like Intel reported some pretty poor results with poor future outlook. So it's really kind of fascinating to see how this is playing out. But this is what has happened on a quarterly earnings basis for the S&P 500. And this is, bottom up EPS, earnings per share. Actual is the dark, I guess, blue, and, estimates are this light gray. So this first light gray one is the fourth quarter. You can see it's expected to be less. Matter of fact, this will be the first year-over-year quarter where we've had less since the third quarter of 2020.
Yeah, 2020.
Yeah. And so earnings are down. And actually, if you really dig into earnings and look at what's going on, I'd say they're mediocre across the board. And they're expected to maybe even come down a little bit more, next quarter. And so this is where all of these big analysts are talking about, and they're saying that the expectations, all those gray bars, are too high. And that as the companies start to report earnings, they're going to say, okay, our forward guidance is lower than what's expected, and all those expectations come down, and the market responds to that and starts to ratchet down. And then we end up with kind of a free fall type of scenario. We get that 10 to 50% drop because of that. So that's what's happening, and that's why, if you look at this, they're still saying that these are too high, right? Now, what's interesting so far, 29% of the S&P 500 companies have reported, right? 69% have beat expectations. Now, that's less than the 5-year average. 77% normally beat expectations. But that's higher than what was expected this time. Yeah, there was expected to be bad, and it's more mediocre. Mediocre is better than bad, right? And that's kind of what's happening here.
Yeah, but we're still early in the earnings season. We're only about a quarter of the way through. So next week we're going to have some big tech companies report, and that could be really changing the market.
Yeah, well, these 2 weeks are really kind of the litmus test pieces because the companies are so large. They have big impacts on the indexes themselves because these indexes are weighted by size of company. And so they're fairly important as far as that goes. And yeah, exactly. It's still early, but I'm telling you, in terms of what was expected, there is at least a fairly decent mixture. In that 29%, we've got the banks, we've got some tech companies, we've got some consumer staples that have reported. And so there is at least somewhat of a mixture. I'd be a little bit surprised to see it be wildly different for the rest. There's bound to be something, though, that where somebody really misses and has some negative things to say. But this is one of the most surprising things I've seen. And this is based on, if you look at a stock, they report their earnings and they have a positive surprise. So they beat, the expectations. If you look at the 2 days before and the 2 days after the earnings report, the average return so far in these reports has been up 1.5%. Average 5 years, 0.9. So it's rewarding companies that have a positive, result for earnings per share at a higher rate, which is interesting because this is supposed to be a terrible scenario. But what's really fascinating to me is even if they have a negative surprise, they come in under expectations, they're still making a positive rate of return in that 4-day period, 0.7% versus negative 2.2. This has to do with expectations being low, and even though it's mediocre, it's better than bad, and people are responding to that, and the stock market is moving in that direction to kind of come back up. And at some point in time, people start to cover their shorts, and then other people see this market moving and they're jumping in because of the fear of missing out. And, so we've had a nice rally off of that as far as that goes. So that's what's going on with earnings. So inflation seems to be, moderating again, still good. Looking at the different indicators for inflation, they look okay. The market is past that trend line. It's kind of met a lot of criteria for a trend change, still a ways to go. And then earnings are really probably better than what the overall investment community figured. And that's why the stock market's been going up. A ways to go on that. And we'll see how that plays out. And we really need to also get through the second quarter, see how this plays out. But one of the fascinating things that I don't think is getting enough press, so to speak, is the situation in China. And so this is an iShare China index, and it buys a lot of the stocks on China. And we don't invest in this directly ourselves, but I'm just showing you this for reference points. This is also from kind of the top, the beginning of last year to now. And this run that we're having in the stocks in China is ridiculously going. And the biggest reason is because of the release of the zero COVID policy. And so this could have fantastic impact on the markets, because what's happening here, second largest economy in the world, is been tamped down for 3 years. I mean, really locked up. Their lockups are not like what we had here in any stretch of the imagination. And so you've got this huge pent-up demand. It is going to be moderated up front here by the fact that the virus is running around like wild.
Yeah, China's reported 80%, eight out of every 10 people has been infected so far with COVID.
Yeah, exactly. And, it's not surprising because this version of COVID is very contagious. Maybe not as lethal, which is good, but very contagious. Expectations is that the virus will run through the entire country in 6 to 9 months. The different epidemiologists, that's what they've been talking about. So that's going to be a difficult scenario to deal with, especially for their healthcare systems and those types of things. So hopefully that works out well. But the market is a forward-looking mechanism. It looks forward 6 to 18 months. And it's looking forward to the period of time when China is past that COVID wave, so to speak, and that group starts to kind of come out of their shell and starts to travel and spend. And the pent-up demand that we've seen in the Western world that's really created some of these big, spends on travel and hotels and airlines, all those types of things. We're probably going to see another big bump out of that as China comes out and starts to get back into a more normal scenario as far as that goes. So the reason this is important is because the big fear right now is that there's big recession coming. We're going to have these big drop downs in earnings, more than expected. The market hasn't accounted for that. The market's going to fall because of that. But on the other side, you have China coming out of its shell. There could be a mismatch in time, because we're talking about recession and earnings problems kind of right now, first half of the year. China's still got the COVID wave coming through, so it could take them a while to really get going. So there could be a little mismatch. But again, the market's factoring this in. I feel very strongly that upward trend right there that we're seeing somewhat relates to what we're seeing in our stock market here. Because people can see that China can keep us out of a steep recession, theoretically, potentially, right? Now, the other weird thing about this, and the really strange thing about this whole environment, is that China could also reestablish a higher inflation rate as they get out and start to spend. They're one of the biggest users of energy, so we could see energy prices increasing as they get going again. And so, services are the big area where we've seen inflation. And so as they get back out there and start to spend on those areas, at restaurants and what have you, and travel, we could see some inflationary pressures, which could be, so that's the weird part about this. One thing looks good, hey, that helps recession. The other side, it looks at it and say, okay, that could be inflationary. So we'll see how that plays out. But I do think this is a story that's not being talked about enough, and how much impact this could have on the markets as a whole, as a global market, to keep us out of some of the more severe recession scenarios that have been kind of played out there. So very fascinating how all this is working out. This is a historic time frame, and watching the markets now and understanding how they work, you're going to learn more in this time frame 2020, 2021, 2022, et cetera, than you might have in any other 3 or 4 year time frame. Just because, again, we've got these dynamics that aren't normally there. And so anyway, that I think this is one of the things that is making people excited about that possibility of less recession, you know, and maybe less impact to earnings, and you know that could help quite a bit. So anyway, that's our outlook for our situation for the last week. Again, we'll look forward to covering that again next week with you. A great time to be watching these types of things. So, all right. So what do we have for our first question?
What's the best way to pay off my mortgage faster?
All right, so this is a question that came in, and we've got a chart for that too. But one of the things that I think, obviously, you have to take a look at several different things. All right, so if you're going to pay off your mortgage quicker, I'll assume that means you don't already have the capital, based on that question. And so now we're going to pay, monthly or something along those lines. We have some extra money. We want to maybe pay that down. What rate do you have? Is it a new mortgage at 6-7%? Is it an old mortgage at 2-something, 3-something percent? Makes somewhat of a difference in how you might take a look at that. But there's quite a few different strategies. Why don't you tell them kind of how out in terms of the extra payment pieces?
Yeah, so one strategy is you round to say you have $4,700 is your standard mortgage payment. So let's round that to $5,000. That's one strategy.
Welcome to Silicon Valley.
That is true. That's actually pretty low.
It is. I know. That's the scary part.
Another one is you could do every 2 weeks you can make a payment, and so the idea is in the end of the year you'd get 26 payments in, and so the idea is you pay off half your mortgage for every 2 weeks, and so you'd get 13 months worth of payments in a 12-month period.
Yeah, and you do the math on those, and they really work. And then one of the main things is you're paying more principal, and it just comes down faster. And there's something to be said for that. But one of the things that also to consider, especially if you have a mortgage, that you either got or refinanced at the lower rates. That's kind of that 2.5 to 3.5 range, something along maybe even up to 4% range, is the possibility of maybe you do pay more. Maybe we round off and we pay a little bit more. And we have some extra money. Maybe take that extra money and think about putting it into the market in some format, especially for the longer term if you're not retired yet, and then let it grow, right? So I've got a picture here I'll show you of the. I'll use this view. All right, this is the Vanguard Total Stock Market Index. It's our main index that we use to analyze the market, and it's really just an ETF that Vanguard puts together that has almost all of the U.S. stocks in it. It's a little over 4,000 stocks in there. And so if you look at this is from the bottom of the last big downturn, which was March 9th of 2009, to, today, right? And maybe we're not at the bottom yet here, but that is a $30 a share price that went up to $200. Long time, but if I'm trying to save for paying off my mortgage, maybe I put some into paying down the mortgage quicker, like rounding and those types of things. And then the other extra money I have, I just put into a brokerage account and I buy something like that. I mean, it's well diversified. Yeah, we're going to have some ups and downs, but that's roughly almost 7 times your money.
Yeah, and so this is kind of just the opportunity cost. If I use my extra capital to pay down my mortgage, what's the opportunity cost? And you could be invested with that money. And so that's kind of the thought process is, yes, if you're going to like an after-tax account, you're going to have some taxes on that. Is the net return that you could reasonably get better than the interest rates you're paying now? And that's kind of that, what is your time horizon? What are your rates? That's what we're trying to figure out. Yeah,
so this is different for everybody. But just, let's say I owe $1 million on my mortgage. And let's say I put money in every month over this period of time, and let's say it adds up to $700,000 in terms of what I put in, but it's worth $1 million. All right. Now I got to pay capital gains tax on an extra $300,000, so I'm still not quite there. But let's just say I have $200,000 of gains. I'm just making up numbers, but my point is, I can have potentially the market help me pay off my mortgage.
Yeah.
Instead of just putting in $1 million into my mortgage of out of my pocket money, I might be able to put something smaller into the market, have the market grow. Again, longer term is a much better way to look at that. If you wanted to do it for any 1 year, don't bother with the market.
Don't risk that.
You might end up with 2022. But if you've got, hey, I'm going to try to, I'm 50 years old. I want to retire at 65. I got 15 years. I don't want to have a mortgage at the end. This is not a bad strategy,
Yeah.
right? I don't think there's been a 15-year period that hasn't made money. And so basically what would happen then is that you have the market being able to help you to achieve that goal of paying it off. And so anyway, that's something to think about in terms of how that works. If you've got a really high cost mortgage, then that's an issue. If you're at 6 or 7%, market's averaging 11% a year, you might be better off, kind of just paying in that mortgage and getting rid of that just directly. But
Yeah, because like when you're paying a high interest mortgage, that's guaranteed,
yeah.
while the market is not a guarantee.
Yeah, that's one of my favorite things to say to clients because, they've all asked questions because you look at investing as a probability game. And so one of the things is, what's the probability you're going to pay less on your mortgage? Maybe if you can refinance it, but it's relatively low. It's a fixed rate. What's the probability of you're going to make money in the stock market? Well, that's a lot less likely. It's a lot less certain than it is. So you got a certain outflow and an uncertain inflow. Those don't match together very well sometimes. But again, for those lower cost mortgages, for somebody who has the time, I'd consider this.
Mm-hmm.
Yeah, I would do this personally in a heartbeat. And I'd probably, I wouldn't try to go crazy and buy some little stocks and stuff. This is to pay off my mortgage. I would have that money allocated towards something like this, just keep going. It's the whole stock market. It's the U.S., which I like, anyway.
Yeah,
so.
for these, I'd kind of keep it simple and stupid, just broad indexes,
Right.
BND, VTI, some combination of that could probably be safe.
It would be great to find, Apple 20 years ago, and boy, you could pay off your mortgage a lot faster. It'd be great to find Tesla, 10 years ago. You can pay off your mortgage a lot faster, those types of things. But for every one of those, you've got a bunch of them that nobody's talking about where half the money disappeared or, those kind of things. And then you're really spinning your wheels. So I would stick for, you're really interested in this case of trying to pay off that mortgage at retirement, for example. That's a decent way to do it. If you have a shorter timeline, can still work, but I probably anything less than 5 years, I would be weary of trying to do this. But it's something that is worth looking at. All right, what do we have for our next question?
Is it better to buy a commodities ETF versus the physical commodity? So a gold ETF versus a gold bullion bar or a gold coin?
Yeah. Well, so a gold ETF, a gold bar, a gold coin. Okay, so that's an interesting question. So if you look at one of them's easier to carry around, right?
That's true.
So there's advantages and disadvantages. Physically owning something like a gold bar, for example, has an advantage of not having to worry about what would happen to the market, the trading mechanism. Maybe you're buying gold as a hedge against a worldwide collapse or whatever it might
your
be.
doomsday.
Right, and so you kind of wonder, well, what would happen with a gold ETF in that scenario if I have a gold bar? Okay. Well, obviously the disadvantage is, where do you keep it? You can obviously keep it in the safe deposit box. Do you keep it in your home? Well, that's kind of, I know people do that, but I wouldn't. I don't want to invite, the thought process. But so that's the pro and con, I think, on a gold bar. A gold coin, I think it's very interesting, and actually I have some clients that collect gold coins, and they have one. I think, first of all, they're very portable. They're pretty easy as far as that goes, but they have an extra value because of when they were minted, the condition, and what have you. And so, because it's a collectible, gold is a hedge. It's a store of value, right? A gold coin is a collectible. And man, sometimes collectibles really outperform the actual value of the commodity that it's made of.
The only problem with a gold coin is your liquidity.
Yeah.
I could go to a pawn shop and take that gold bar and sell it to them, and they'd give me pretty close to spot. You know,
Yeah.
they'd take some off. But
Right.
if I do that with a coin, it's a little bit of a different market.
Oh, well, it's a debatable, negotiated situation, really. I mean, it's not something where you can just go in and, because it has to do with the quality of the coin, and your thought process of the quality versus somebody else's could be different, right? I mean, that's kind of how it works as far as that goes. So if we get back to the gold ETF as the last piece, so I think from a pro and con standpoint, first of all, it's super simple. I literally can buy GLD, which is a gold ETF, right on any one of you can buy it in your IRA, you can buy it in your brokerage account. It's super simple as far as that goes. It does have this appreciation, potential as far as that goes. We did have a chart on gold from last week. Yeah, here it is. I'll share this real quick because I think it's kind of interesting. So there's GLD, right? And that's the orange line there versus SPY in this case, the S&P 500. And so, hey, it's done well, right? I mean, this is just a short period here, really short. But it's having a nice run, so you can make some appreciation. Theoretically, it might be able to, hedge some different situations that are out there. And so I probably, like anything else, diversify the concept. If you really want to deal with this, have all three. What's wrong with that? You could have, if you took a third, and a third, you wouldn't be doing too poorly with your money for that standpoint, because they all have pros and cons. And I think if all three together, you might have a really good mixture, right? And so anyway, that's a great question. It's kind of fascinating. This is a very, very popular ETF, again, because there's gold behind the shares, literally, so it's kind of an interesting ETF. It's a little different. But you never know in these kind of digital scenarios how it's going to work out, and maybe that's why it's good to diversify in some of the actual hard assets, if that's what interests you. All right, get back to, I lost my thing.
There we go.
Oh, sorry. There we go. Got it back. Yep. That's why I'm hitting the wrong button. All right. So what's the next question?
What is the Fed blackout period?
Oh, good question. The Fed blackout period. We're in it right now.
Yep.
It seems to start on a Saturday for some reason. And it revolves around the Fed meetings. So the next Fed meeting is Tuesday, Wednesday. They'll come out and, do a question and answer session on Wednesday. They'll tell us, how much they're going to raise rates and kind of what they see and all those type of things. And so prior to that, they're not allowed to talk at all. And that's probably why, what was it, a couple weeks ago or the week before this one?
Yeah.
We had a down week altogether. The Federal Reserve was out like mad. I mean, they did like 7 different interviews, all negative. The market was down for the week, and they're really trying hard to use their words to bring it down. And one of the reasons I think that we're having a better week this week is we don't have the Fed. They're in a blackout period. So that's what it means. So I don't know how many days it is in total.
It's like 12. It's 12. Not like 2 weeks. It's kind of weird because they like to close. They like to start it on a Saturday, so after like the markets close.
Okay, got it. And then it even goes one day past, I believe, past the actual meeting. So it might go to February 2nd.
Yeah, it's February 2nd is one after
and then
that.
all of a sudden, I guarantee on February 3rd, we're going to have interviews with Fed governors, and they're all going to be saying the same things. Because the weird part that we're dealing with right now is just this situation where the Fed would really like the stock market to not do what it's doing right now, in the way it's running this week. I've said this before, they can't actually keep the stock market down with just their words. We call it jawboning. It can be very effective, especially up front. We had a pretty big drop-off last summer after the Jackson Hole conversation from Chairman Powell, 8-minute speech, no questions, hammered the market, dropped 3% that day, and really started the whole downturn from that run-up we had last summer. So it can have big impacts, but you look at a week ago, lots of interviews, lots of negative things. We might go to 5.5%, even though the market's thinking 4.9, and all these things. And we still ended up with a good week this week. Because I think I think it's starting to wear off with its effect because the bond market's not responding to their
Yeah, it's like the boy that cries wolf.
Yeah, that's a good point. Exactly. All right. What else do we have for questions?
With gas prices increasing, how does that affect CPI and then the Fed's interest rate increases?
Yeah, so CPI is the Consumer Price Index. This is a measure of inflation. It has a basket of goods that it looks at, like rents and healthcare. Gas is one of them, food. And so top line inflation, which in CPI, which includes all types of inflation, including energy, like gas, would be affected by higher gas prices, obviously. So we've been watching CPI come down and down and down on that top line inflation pretty consistently since June, July of last year. And so if all of a sudden gas prices take off and come up, we could see CPI coming up. And that would disturb the market. Certainly in the 70s, one of the big things that really created high inflation was the energy crisis that we were in at that time. Yeah. And honestly, there was a big expectation we'd be in an energy crisis now. Right? If you remember, for the first half of last year, gas prices are going through the roof. February 24th, Ukraine was invaded. Russia does 11% of the world's oil. And their expectation was oil was going to go up. It went up to 130. I heard estimates at 260. Yeah. Right. It's in the 80s now, I think. I haven't looked today, but did better than expected. But it would have a negative impact on CPI. That would come through as a negative impact to the market. As far as what the Federal Reserve does, it's very fascinating actually, because historically the Federal Reserve has only really looked at core inflation, which does not include food and energy. And by their own admission, the reason that they do that is because they don't have that much impact on the food and energy prices with their main tool, which is raising interest rates. But last year, Chairman Powell several times in the question and answer session talked about gas prices being high. And he mainly talked about it in the response to the surveys for what consumers think is going to happen with inflation. If you look at that survey, it is directly tied to the price of gas. Everybody thinks inflation is going to go way higher when gas is going up, and right now the surveys are coming out pretty good. Oh no, inflation looks great, because gas has come back down, right? From that point anyway. And so, for whatever reason, they were talking about it and talking about the possibility of being able to slow down that demand. So I assume with this Fed dealing with this level of inflation, that it would create a higher potential for interest rate increases on the Fed funds rate, again, which would be a negative to the stock market. So gas is one of those things, that is out there that is definitely volatile, could move quickly for a variety of different reasons. Seasonal also.
Yeah, usually in the first 6 months, gas prices tend to go up, and it peaks out usually in June and July is when your gas prices peak out.
Yeah, and we still have some structural problems that happened from the pandemic because we had a lot of refineries closed down, and so when gas usage jumps like it did as things reopened, the refineries weren't there to create gas from the oil, and some of these refineries have had a really tough time reopening, and some of them haven't reopened at all. And I read about one, for example, I think it was in Pennsylvania. It was going to take a $150 million redo to get it up and running again. And nobody wanted to put the money in because it's like a 10 to 20 year payoff period. And people are worried about the green energy and the other energy sources coming along. And if I'm a hedge fund or whatever might put $150 million into something like that, I'm worried about getting my refund, my results back and making an adequate rate of return. And so this is one of the weird things that's happening. The price of gas could go up as we move farther and farther away from gas because people aren't wanting to make it and to invest in it.
Yeah, the supply side goes down.
Yeah, exactly. So very, very interesting to see how that plays out as far as that goes. It's a really tricky market to make a guesstimate on. You just kind of watch and see what's going to happen. Because again, I would guess that if you talk to most of the experts, by this point right now that we're speaking, they would expect gas to be even higher than it was at its highest point last year, and that hasn't played out for a variety of reasons. But nonetheless, it's a volatile commodity. It's one of the reasons why they look at CPI and CPI without energy and food, because they're both kind of volatile commodities that are sometimes, run their own course for a while. So we'll see how that plays out, but it's a good question. All right, I think we've got time for another one.
Should I open a 529 account before my grandchild is born?
Oh, interesting. Proactive thinker.
Yeah.
Pretty excited probably about having the grandchild. I could see that. And so want to start the process as soon as possible and get the money going in there. Obviously, for those of you who don't know, 529 is a college savings plan. You put money in, it grows tax-free as long as you take it out for, what they qualified reasons, for expenses. And they've expanded that, and that's gotten better. But it's a great vehicle, really popular as far as that goes. But you're kind of the expert on the 529 stuff. What would happen if somebody started before a child was born?
So when you have a 529, you can, if you're saying you're the existing beneficiary, you can contribute to it, and there's no kind of gifting or anything because it's your own money. It's still your own money. But when you go to a different generation, so let's say from your generation to your grandchild's generation, it's considered a gift event. And so with that gift event, it triggers gift tax. So if you're below the annual exclusion of $17,000 per year, it's fine, no problem. So you just you change that beneficiary to a grandchild when they're born, and you're totally fine. But the problem is you run into it is if you try and overfund it. So, a lot of these 529s, they have contribution limits in the 200,000s or higher. And so if you were just to put that money aside instantly and then change the beneficiary to them, you would trigger some gift tax.
Yeah, I would say it seems like a bit of a hassle for what you might get out of it. Because if you have a grandchild on the way, it's going to be less than 9 months.
Yeah.
That's going to happen. And, how much are you going to make more? You might have to wait a little bit after the grandchild's born for Social Security number and those types of things. But I might wait personally.
I don't think it's worth the hassle.
Yeah, I wouldn't think
just
so.
to
either.
risk that gift tax event. If you're going like 5,000-10,000, is it really worth the hassle to do that at that point? I wouldn't say so.
Yeah, it's exciting. Save your money in a savings account or something. Be ready to go. Put in what you can put in, and then just keep contributing. College costs are, not going down anytime in the future that I can see, and it's a big burden. And having that tax-free growth can really help, especially starting early. That's great. You come in and try to save for college at 15, you're not going to get much growth.
You got that, that compounding of your interest.
Yeah, you start when that child's, 3 months old. Boy, that's going to help a lot. So yeah, I have some clients where the grandparents are competing with each other. So one grandparent's putting, 25,000 to 529. The other grandparent calls me up, is my client. I need to put 50,000. That's a good scenario to be in. How would you like that?
The nice thing is, if you fund it early aggressively, you don't have to fund it as you go on.
Oh yeah, exactly. Like anything, even like the retirement planning we talk about all the time. That what you save in your 20s could really make a huge difference versus somebody that starts say in their 40s. But you have to have the money and you have to be able to do that. But that's a great concept as far as that goes. So. All right, good. Well, another show, another Friday. Again, we're going to be here next Friday. Look forward to being able to talk to you. Again, next Friday, we'll be talking about another really big run of big-time earnings that are going to be coming through. That'll be fascinating. And, of course, the Federal Reserve will be having their meeting on Wednesday, so we can talk about what happened there and what we saw. So look forward to seeing you next week. Please, feel free to send in your questions now for next week. Anything you can think of, we'll try to answer those as far as that goes. And then, of course, you can subscribe to the channel. We feel the more you know, the farther you'll get, and the better your retirement will be. So that's what we're putting on this channel, is things to help you with that. You can hit the bell to get the little, notifications when we put something new on there. And then obviously, lastly, you can also meet with Ethan and I, hit the book appointment button that's on our website, pick a 30-minute video or phone time, and, chat with us and tell us, what you've got going on and see if we can help you. All right. Thank you very much. Look forward to seeing you again next Friday.